Hello friends, welcome back to Block Bytes. This video is dedicated to Jenu Joseph, a subscriber to my YouTube channel, and the one who requested that I cover the topic of real world asset. If you did not know already, asset tokenization, also known as real world assets, is the most significant crypto adoption narrative. Banks, financial institutions, and companies around the world are all discussing it, and they have started to see the technology's immense potential. This subject deserves special attention, so I've decided to make multiple videos covering it. Here is the list of topics that I will cover throughout the series, starting with meaning of asset tokenization, or RWA, followed by use cases of asset tokenization, the various advantages it provides, then we'll look at the process of tokenization, followed by any challenges or disadvantages there are. Then we will look at the current blockchain real-world asset ecosystem and the various projects in it. And in the end, we'll look at some metrics and reporting on these projects. I will cover the first three sections in this video to help create a base understanding of asset tokenization. Let's begin with the obvious question. What does asset tokenization mean? The primary idea behind real-world asset tokenization is to build a virtual investment vehicle on the blockchain tied to tangible assets such as real estate, precious metals, art, and collectibles. In other words, it is a way in which physical assets can be traded on blockchains. So, instead of a piece of paper, the ownership of the asset is recorded on chain. This ownership could be traded directly between two parties or fractionalized and sold to many people. Let's take an example to understand this. Imagine that there is this Picasso painting worth 10,000 or rather 10 million US dollars. Now imagine that shares of this painting can be bought and traded. So this painting could be digitally broken down into 2,000 shares, with each share costing only 5,000 US dollars. This expensive painting is now affordable to many who would have otherwise been kept out of it. Interestingly, this is not just an idea but a reality. Websites like Freeport and Masterworks already do this. But why add blockchain? If these 2,000 shares are all on chain, owners can trade these with other buyers without any middlemen, as would be otherwise. They can be traded anytime throughout the day, 365 days a year. And since the entry barrier in terms of cost has already lowered significantly, the market has increased exponentially to include millions of prospective buyers, which would otherwise not be possible. This was a particular example, but you get the idea. Like paintings, other collectibles can also be tokenized and fractionally traded on a public blockchain. Let's look at some other use cases of tokenization. The scope of tokenization goes way beyond just collectibles. Equity or shares in companies can be tokenized, real estate, currencies, commodities like gold, government debt like bonds, collateral-backed loans can be tokenized, and many other things. As a matter of fact, this is an endless list. Let's take collateral for instance. Now, collateral lending is an asset that a borrower pledges as security for a loan. If you want to take a loan to do DeFi activities, but want to use a collectible like a painting or a house as collateral, then tokenization can help. Your physical asset can be tokenized on chain, and you can then take a loan from MakerDAO using this tokenized collateral. As a matter of fact, MakerDAO already has real world assets over 3 billion US dollars as collateral on its platform. Another example is intellectual property. Suppose you run a successful social media company. In that case, you can tokenize your copyright and sell it to anyone willing to buy it. Also, if you earn annual royalties, you can get a loan from a lending company against this future earnings. Shares of companies you buy from a registered trading company can also be tokenized on chain. So now you can buy and sell these shares for a much lesser trading fee. Also, fractionalized shares can be traded just like Picasso's painting. Cash or currency is being tokenized too. Stable coins like USDT and USDC are tokenized versions of cash. CBDCs are also tokenized versions of cash. CBDCs allow central banks to reduce operational and capital costs as they no longer need to procure paper and print physical money. Another important use case is in the supply chain. A supply chain is a complex logistics system that consists of facilities that convert raw materials into finished products and distribute them to end consumers or customers. And at every step of the way, there is need for capital and cash flow. So tokenizing assets involved at any stage like invoices, payables, and inventory can help create secondary markets to improve supply chain financing and tap into banks that accept tokenized form of collateral. Tokenization can also create digital tokens representing the cargo's location and status in the supply chain. This can increase transparency, reduce fraud, and improve supply chain efficiency. These are some of the use cases for asset tokenization. What are the advantages of tokenization? Now that we understand tokenization and some of its use cases, let's focus on the advantages this brings. Number one, increased efficiency. By eliminating the need for intermediaries, blockchain technology reduces settlement time because of automation and increased transaction speeds. Second, reduced costs. Automation, transparent record keeping, and dependence on public blockchains result in considerable cost savings. 3. Better compliance. Blockchain decreases the chance of error and makes complicated compliance needs cheaper and easier to administer by writing compliance rules directly into code. Fourth, improved liquidity. Tokenization exposes assets to a global investor pool and allows trading of previously illiquid or non-fractionable assets. Fifth, increased transparency. Public blockchain promises to give a single source of truth on which all stakeholders can rely, which help reduce disagreements over record keeping. And sixth, facilitates innovation. With programmable contracts and shared ledgers, it is possible to build new investment and trading products like fractionalized real estate, liquid revenue sharing agreements, dynamic ETFs, and other previously unmanageable services. Let's take the example of the Picasso painting again to understand these advantages. First and foremost, a painting can be broken down and sold as units is impressive. However, existing portals like Masterworks must buy the painting before they can use their internal systems to break it up into units. They do not have to buy the painting with blockchain technology. Masterworks can have a system where the painting is tokenized on public blockchains, automatically breaking it up into units or shares, and listing it on multiple marketplaces, including their own. So here we see innovation, cost reduction, and increased liquidity for Masterworks, as these units can also be listed on OpenSea and other Web3 NFT marketplaces. Next, since everything is done on code, the time to list the painting, break it up into shares, put it on marketplaces and engage in transactions is instant compared to how printings are currently sold. This level of automation makes the entire process fast and efficient. Not only that, all these activities are recorded on the public blockchain and cannot be tampered with, enhancing transparency and compliance. So here we go. This provides a glimpse into what asset tokenization is all about and also explains why everybody is talking about it. This video taught us the basics of asset tokenization, also known as real-world assets. We understood what it means, looked at some examples of where it can and is being used, and learned its advantages. In the following video, we will look at the remaining sections. I hope you like this video. Do like and share, and I will see you next time with another fresh bite. Bye.